Welcome back, welcome back, welcome back. Now, what up, though, man? It's your man's Fresh. Welcome back to another episode of Finance with Fresh. I'm your host, Fresh. All right, so real quick, do me a favor. Stop what you're doing, pause, and subscribe. Click the button down there for bell notification. Just go ahead and subscribe to the channel so you can get a update, a notification when I drop a new show, got new material, etc. So just go ahead and do that for me, man. Click the button, like, subscribe, comment, etc. Without further ado, let's jump into it. So the title of today's show is why saving is for losers. I had recently just did a show centered around paying yourself first, and I had said a phrase when I was recording the show. I said saving was for dummies or for losers or something like that, and I had got a response just wanting me to clarify what I was saying. Okay, first of all, let me say, I'm not trying to offend nobody or none of that like that. So please, don't be insensitive. Well, I should say don't be sensitive about some of the things that I say. It's just jargon. It's just talk, just to get the people going. It's provocative. You know what I mean? So, just add some character to it. But why I think saving is for losers is based off of simple math, and we gonna break that down in today's show. So that's what we're gonna do. So real quick, let me give y'all the why, the how, and the what. Why I'm doing this? I'm doing this obviously because people need this information, this vital financial information to help them make conscious decisions when it comes to making financial decisions. You know what I mean? Take care of their family. That's the number one reason. I'm trying to get people to reach a point where they see the equity in everything. You know what I mean? Just really striving to reach and understand what equity is, how to obtain it, etc. So that's why I'm doing this. You know what I mean? Coming from Detroit, the blackest city in America, it's not often that you're gonna get people that's gonna give you sound, crisp, concise advice. Like a lot of this stuff I had to learn on my own. So, that's why I'm doing this. So how I'm gonna do it is just that. I'm gonna give you some sound, good, solid information that you can research yourself. You know what I mean? Don't take my word for it. That's another thing too. Like, stop putting who you think is or gives you good information, good educational material. Stop putting us on a pedestal, man. We no different from you. That stockbroker, that real estate guy, Warren Buffett, whoever it is that you hold on this high pedestal as to be the end all, know all to finance and all of that stuff, they don't. No, it's no one sound strategy or nothing like that that's gonna get you rich quick overnight. No, it doesn't. 9 times out of 10, when you do the research and you figure out what happened, it doesn't happen like that unless you hit the lottery. All right, so what is it, man? Let's just kind of jump into it. It's that time. Let's jump into it. So, why is saving for losers? This is a very ironic conversation because I actually was segue to talk about my personal life. I actually was dealing with a young lady around last year this time, and I was trying to get her to understand this concept, and we got into this huge argument. Like, I really think the energy or whatever you want to call that we had got destroyed, all because of this concept of me trying to explain why saving doesn't work, why it's for losers, etc. Not to be derogatory, but that's just hey, I can't wrap my hands around it. And I'm gonna give y'all some good solid examples on why saving is for losers. Yeah, I don't think I really need none of this. I can kind of delete all of this. So, I don't know if y'all do y'all research, y'all know, just off the top of your head, but everything is based off of what they call a rate, okay? The word rate is the key word. So you like a lot of times in terms of finance, people just hear terms that's being floated around, and I feel like that's the biggest barrier that stops people from really understanding and utilizing and manipulating finance to their advantage, is really deciphering through the terminology and understanding what everybody's saying. Like for a long time, that was the barrier for me. So inflation, okay? For those who don't know what inflation is, because I got to take y'all back, because it goes all the way back, all right? So before, like back in the days, you know what I'm saying? I'm not going to give you no date because that's irrelevant and that might confuse you. So before, it was, for every piece of dollar, if you look on a debt or currency, I think I might got $1 in my pocket, some sort. Okay, I got $1, right? So when you look on the currency, it tells you that this note is a legal tender for all debts, public and private. I say that to say that it's a legal tender for all debts. Debts is the key word that's on there, right? So as a debt, what is it a debt for? It used to be a standard of exchange between this piece of paper and gold, okay? Matter of fact, I got $1 in here. I think this would be better, all right, for this example. Okay, so we got $1 right here. Used to be able to take this $1 and go take that and exchange it for one piece of gold. It was called the exchange rate. For those of y'all who into history, after the Great Depression, fiscal policy changed, monetary policy changed, and they made some adjustments, and I believe it was Nixon or someone, I'm not sure, don't quote the president, don't quote me on the president, because that's not really important for this conversation. It was either Nixon or Roosevelt, one of them, I'm not sure, but they took out the gold standard. I believe it was Nixon, because Kennedy was trying to save it, and this was part of the reason why some conspiracy theorists believe Kennedy was assassinated. So when they took out the gold standard, what that meant was for that piece of paper, for that $1, that piece of gold that you used to get, it changed. Once they start printing money past the point of value. So when you think about it, it's like this. When you print more money, so if we got 100 pieces of gold and we got $100, once we print over 100 pieces of dollars, so once we go to 101, the value of that dollar starts to decrease, because it's not worth the one piece of gold. It's worth just a little bit less than that. And then the furthermore you do that, so if I take the $100 and I change it to $200, then that means your dollar is half the value that it used to be. And that's the simplest way of explaining how inflation came about. And with inflation, you got a rate of inflation. Like it inflates at a certain rate. The US has an inflation rate of about 2.4% annually over the past 10 years. Like that's what the inflation rate has been average wise over the past 10 years, 2.4% inflation rate. So with a 2.4% inflation rate, what that means is $100, for example, once we go into the next year, that $100 is worth 97.6, which is $97.60 going into the next year. That's what inflation does, right? So saving. Now let's get back to saving. when you look at saving, primarily the account used for savings is this called the savings account. That's why it's titled the savings account, which is ridiculous because it doesn't save any money. It's the biggest scam and play on words that they got. Okay, so savings account, savings rate, which is like astronomically low in my opinion. The savings rate is 0.05%. No, that's not a mistake. I really said that. It's 0.05%. Not 1%, not 2%, not 10%. It's 0.05%, a 0.5% inflation rate. That means your $100 would turn into $100.50. You feel me? $100.50 is what your $100 would turn into with a savings rate of 0.05%. And at the same time, you lost 2.4% or $2.40 due to inflation. So if we did the math, 240 minus 50 cents, you have a net of negative 190 inflation rate. So that means if you just left your money in the bank, you paying. Like, it's bad enough you got the bank fees and annual fees and all type of fees that these companies are coming up with to try to get a dollar out of you, which I'm not knocking it because I'm for capitalism. So it's just understanding where you are at so you can play the game. And that's what it's about, right? So now I gave y'all the savings rate. I'm gonna go down and give y'all a bunch of other important rates that I think is key when we talk about sound investment. Remember, I talked about investment vehicles in one of my previous videos, and a lot of these rates that I'm gonna be giving you is dealing with these specific investment vehicles. I wish I had one more on here that I don't have, which is for the Forex market, foreign exchange market, which I think it would be hard to kind of like get a rate of inflation or exchange rate for that because it fluctuates. Forex is based off of the perceived value of the currency. I don't want to say perceived technically because it technically doesn't have to necessarily be perceived. It could be actual value, but it is based off of an exchange value. So example of that might be when I go over to Canada and I take $100 over to Canada. I'm not sure which currency value is higher right now, so don't let me lie to you. But let's just assume in Canada is lower. I'm gonna take my 100, I'm gonna get 150. Let's say the inflation rate changes while I'm over there or something like that, and I come back and the inflation rate is a little lower, and I come back with my 150 and they give me $95. That would be an example of how the rate of exchange works and how it fluctuates, etc. So that's Forex. But I do got a list of a lot of other rates of exchange or averages, ROIs and stuff like that. For those of y'all who don't know what an ROI is, which I feel like is one of the key points when we talk about investment, because that's all that really matters at the end of the day when we do an investment, is what's our ROI? What's our return on investment? That's what ROI means, return on investment. That's the key point. Stay attached to your return on investment. All the other emotions, put them in your book bag, throw them away, go toss them over a bridge, because money doesn't care about your emotions, okay? Money isn't an emotional thing. It's a tool. It's here to be spent, used, and build. That's what money want to do and want to work. When it don't work, as you can see, savings, which is money sitting around, it lose money. When money isn't working, it lose value, okay? So now we about to go through some go through to some rates. So the rate of inflation in the real estate market averages 4.2% a year. So just looking at inflation in general for regular fiscal fiat currency versus the rate of inflation to purchase real estate, you see that you're losing. The average national inflation rate is 2.4%, and the real estate average inflation cost is 4.2%. Now, the return on investment for real estate investors, average return on real estate investment is 10.6%. Okay? So, return on investment is what you make afterwards, after everything is taken care of. You pay for the operational costs, taxes, and etc. This is your profit, basically. Return on investment, how much is that? The average return on investment for a real estate juncture is 10.6%. For commodities, that's like oil and different things of that sort, wheat and barley, buck, different material type of things. You could consider metals and precious metals and stuff like that as commodities, but I got a separate chart for gold. But just in general, commodities, they have a return on investment percentage of 10.64%. Now, this is vital information. These ROIs are vital information for when you're investing in these type of investment vehicles and industries. Knowing what their return on investment rate is vital. That's what you call market analysis. Before you go into any industry, any market, any business, you have to do a market analysis before you make any type of investment. I would say that I'm an expert at doing market analysis. Like that's all what this is. This information that I'm giving you is market analysis. All right, to continue on, large cap company. What a large cap company is, the word cap is capacity, stands for capacity. That just means that they have a capacity to reach a larger market. When we say the word market refers to the amount of people or people in general, a demographic. A market is the marketplace, where you sell, where you buy, where you trade, etc. So large cap companies, a large cap company example would be like a Tesla or an Apple. Large cap companies return on investment annual rate is 10, and these are annual rates, by the way, 10%. Annual just means yearly rate. Yearly returns on investment. To continue on, a small cap company, which is a small business, mom and pop. That's the store on the corner, the gas station, long as it's not like part of a national brand or etc. But you get what I'm saying. It's a small cap company, reaches a small cap size of the market. Their return on investment is 15 to 30%. Which out of all of these rates and return on investments that I'm going to be giving you is the highest, which is this small cap company, 15 to 30% investment. Now, I do want to say this. These are averages, okay? So this is the whole entire market summed up. There are outliers, meaning that I could perform better than you could perform. You could perform worse than the averages. I could perform better than the averages. So these are averages. Don't get hung up and caught up on the averages that I'm giving you and thinking like, oh, damn, that's all I make. That's all I can make. That's all the potential. No, don't. I'm not putting a cap on where you can grow yourself or your expertise too. But these are the averages for the market, which is important to know, just so you can kind of like keep yourself in a sensible range when you thinking about your return on investment. A lot of times I feel like people have this drastic off read from what a proper return on investment should be. And that's why I just gave you small cap 15 to 30, large cap 10%. Bonds. Bonds, which are essentially loans. There are different type of bonds, and we can get into that in another episode. Municipal bonds, government, different type of bonds. 5 to 6%. Bonds bring 5 to 6% annually. Annuities, which come at a fixed rate. Fixed means it's not going to fluctuate based off of inflation. It's agreed upon, etc. Annuity is something like a trust or like a retirement account type of thing. But they have a 3 to 5% return on investment. IRAs, which is an investment retirement account. This is how I actually began to really debunk finance and learning about finance. IRA, which is AKA a 401k type of thing. They have different type of Roths and all of these type of, they're supposed to be good. But when I did the research, I had an other guy at my job, and he was trying to tell me how good the Roth IRA was versus the regular IRA, and neither one of them joints is what I would prefer. And I can break that down in more videos, more advanced videos. But the IRA has a 7 to 10% return annually. High-end yield savings account, which is a joke to me. The reason why I say it's a joke is because high-end yields, to me, describes something that yields high ends. And that's anything but a high ends yield savings account. To me, it's another form of a scam. It's the daily 401k scam, giving people your money. I mean, it's hard for me to call all of this stuff a scam when we willingly give people your money. You actually sign documentations. Sometimes you'll actually pay someone to take your money and do whatever they want to do with it, and don't give you any type of equitable shared interest return in that. But moving on, savings rate, I did that one first. That was 0.05%. Inflation rate, 2.4%. That's all the rates I have for you. So with those rates of exchange and understanding inflation, you can begin to do some market analysis for yourself and begin to make some sound financial decisions, and stop listening to people, just tell you bad advice. So unless you're saving up for an investment, like a direct investment that's immediate, like within the next 1 or 2 months or something like that, saving is just a bad financial strategy. That's what I'm gonna say. I'm not gonna say it's for the losers. I'm just gonna say it's a bad financial strategy. And I don't promote bad financial strategies. Like, that's just not what I do. Why would I self-proclaim myself as a financial coach and I promote to you bad financial strategies? That's just, So this is the same type of stuff that I would tell my kids. This is the advice that I would give my kids. This is what I'm going to be coaching to my daughter. Get you some Bitcoin, man. Get you some Bitcoin. If you're one of them people who still in denial about Bitcoin, my next video is going to break down why Bitcoin is the hottest and most important investment. And it's not necessarily just like Bitcoin, but you have to understand why I'm promoting to you to get Bitcoin. And once you understand why I'm promoting to you to get Bitcoin, that will signal that you on a sound wave of understanding financial information. So therefore, once things do change, if they change, which I don't see them changing anytime soon, then you'll be prepared for that. You'll know how you'll be able to do the proper market analysis and make the proper decisions. And that's just why I do this, man. Just to give y'all this sound good information. Letting y'all know I'm about to get everything together, about to get some flyers and all of that stuff. It's gonna cost if you're gonna want to have a real in-depth conversations with me. I can't continue to do this free. And it's not that I don't love helping people. That's what I'm doing the YouTube for. This is just because I got to secure my financial future. You know what I mean? I need money so I can make my investment, so I can show y'all how this works, so y'all can really give me my credibility. Because when I really jump into that wealth, then everybody gonna come to me and be like, damn, bro, you told us, bro. You right, bro. You was tough. You know how y'all do, man. But anyways, without further ado, I ain't gonna hold y'all up, man. It's another episode with your man's Fresh. Thank you for tuning in. Finance with Fresh. Again, man, make sure y'all subscribe. Click on the notification, subscribe, like, comment, shoot me a message. Let me know if you got a topic you want me to really talk about, dive into on a financial level and perspective, and I got you. But other than that, I'ma holla at y'all, man.